Welcome, Greek U Nation, to episode number 456 of the Fraternity Foodie Podcast. I'm your host, Mike Eilon, CEO of Greek University. I'm a speaker and an author. Our fifth book just came out. It's called Perseverance and How to Be a Great Fraternity or Sorority Alumnus. So go and pick up that book on Amazon or Barnes & Noble today. We call these episodes the Fraternity Foodie Podcast because there is nothing like great food to bring fraternity and sorority leaders together. Fun fact, as I travel the country and I speak with college students today, many of them are talking about investing in some form, whether it be crypto, the stock market, real estate. They're all thinking about how they can build wealth for themselves and start that process as early as possible. Based on that idea, I decided that it would be great to have an expert on the show to talk about long-term investments and how college students can start to make that process happen. Andrew Parrillo is the author of Beat the Wealth Management Hustle. He is a Boston University graduate. He is a founder of Newport Capital Advisers that he managed from 1995 to 2019, as well as managing member and founder of Victory Road Investors from 2000 to 2020. He had various investment advisory roles at firms before founding his own firm back in 1995. Welcome to the show, Andrew.
Thanks, Michael. I appreciate being on. I look
Hey,
forward.
listen, anytime we're talking about investment and making money, I am all about it. And I know all of our listeners want to hear more about it too. So I said, hey, this is the perfect opportunity. So thank you for joining us.
Oh, my pleasure.
Yeah, so let's talk a little bit about your undergraduate experience. I'm just fascinated with college, and you decided on Boston University for your college experience. I tell you what, I just recently came back from a tour last summer of Boston University. That campus is absolutely beautiful. The train into downtown Boston is super convenient. It's steps away from the campus itself. So I'm wondering, what made you choose Boston University?
Well, first of all, I'm from Rhode Island, okay, a small state. And I just wanted to get into a bigger environment with more people from more places. It turns out that most of my classmates at BU, it turns out we're from New York. Of course, they were from all over the place. It's a lot more diverse now, probably, than it was then. But yeah, and the other reason is, Boston. And I have to say, I mean, until I went to BU, I wasn't that familiar with Boston. I'd go to some Red Sox games, but as a kid, I mean, I didn't hang out in Boston.
Mm.
Boston is a unique city. First of all, it's a young city. There obviously are a lot of colleges and universities there.
Mhm.
It's a relatively small geographic area, so it's pretty easy to get around. You don't need an automobile to get around Boston, and which is not the case in a whole lot of places. And the trains are accessible. The airport's accessible, and it was just a fun place to be. Now, I was there from 1965 to 1969. That was a whole different era.
Yeah.
And at that time, we had, and most people, I'm an old dude, all right. So, but at that time, we had the draft. We
Yeah.
had the military draft, and
Yeah.
so you get a college deferment as long as you're in college. So I did, and then when I got out, of course, I had to do my military service, so I did. But also in the 60s, the late 60s, not unlike today, there was a fair amount of turmoil on the campuses. And there were demonstrations against the Vietnam War at that time. And so history does kind of repeat itself. And that's something that's important to underscore when we talk about investing. Okay, because history does tend to rhyme.
Yeah.
And so anyway, that's so I don't know if I really answered the question. One of the things I will say, since this is a foodie, and I happen to be a foodie, I love to cook.
Yeah, me too.
I'm not up to the minute on the best restaurants around BU or even Boston for that matter, because things change so much. But there are some old standards that were probably not standards anymore, down in Haymarket Square and so forth. But one of the places that's really accessible to BU for the people who really like French bakeries, there's a real French bakery in Brighton, which is right up Commonwealth Avenue. So it's a short T ride up the street. And it's called Clear Flower Bakery. And it's got the most authentic baguettes and other pastries that exist in the Northeast.
Yeah.
actually.
Yeah.
I'm told that by Parisians. Okay, so that's not just my opinion. But I have to say, if you like food and if you like pastry, French bakery items, that's the place to go. And it's accessible to BU.
Yeah, that sounds absolutely delicious. And I know you mentioned that you joined SIGEP over there as well. I'm just curious, what made you want to join SIGEP and those particular guys?
Well, there was a good group of people. It turns out it was on Bay State Road. I don't know if you know, Bay State Road is sort of a road that's parallel to Commonwealth Avenue. It's a short span of road.
Mhm.
It has some, well, it's probably changed a lot in 50, 60 years, but there was this 135 Bay State Road was our house. And it
Mhm.
was this old townhouse that was a multi-story, and it looked out on the Charles River in the back. So our dining room, well, the back rooms were looked down the Charles River, and the front, of course, was Bay State Road. It was a really elegant old place with oriental rugs and so forth. And yeah, we had yeah, so it was just a good group of people. It was something to belong to, and otherwise kind of a big sprawling community. And so it kind of brought things together. And you know, and I suppose that's the reason for fraternities, is
Yeah.
it not?
Yeah, absolutely. Well, listen, I mean, they were all founded based on people coming together to debate the issues of the day. In the late 1800s, early 1900s, there were a lot of topics that universities really didn't want to discuss on campus. And so the fraternities just said, well, we're taking it off campus and we're going to have a house and we're going to talk about everything you don't want us to talk about.
Right. And then of course, I shouldn't say of course, but hey, look, I was a kid, all right.
Yeah,
Um, then there were the toga parties,
sure.
and and if anybody's ever seen,
Animal
Animal
House.
House, which was based on a fraternity at Dartmouth, I gather,
Yeah.
you get the idea that that was obviously way over the top, but not that much over the top. Things were pretty crazy back then.
There's
There
some
was
truth
there
to
was
that movie, huh?
Oh, there was some truth. Well, there was the party aspect, but it was also just having, the brotherhood
Yeah.
was important. I say brotherhood, and there were obviously sororities, and that particular street, Bay State Road, had MIT fraternities as well as BU fraternities on it.
Yeah, that's just an incredible place. You know, my daughter was considering going to school in Boston. She ultimately chose Rice University in Houston. But I tell you what, I mean, the people that come together in that town from MIT, Boston University, Boston College, I mean, you can just go down the road, Harvard, obviously, and so many more. I mean, I just think about the brain power that is assembled in that city, that no matter where you go to, whatever pub you end up at, you're probably going to meet somebody who's absolutely brilliant. So, that must have been an amazing city to go to college in, you
Well,
know?
it really is. I think the city, if you think about the cities around the country, at least the ones I know, it is unique. I mean, it's relatively small geographically, as I've said.
Mhm.
It's got the Charles River, which is iconic. I mean, it's just, so I used to sail, so I get the little sailboats and sail on the Charles. But it's just a unique place, and the proximity to, the ocean and the mountains and so forth is pretty good. It's just it's very different. I mean, and there are some great cities in our country that are more college oriented,
Mm.
but I don't think there's anything quite like Boston.
Yeah, I'm with you. I am completely with you. Now, you were an institutional investor for over 4 decades. Now, given that experience, many of the college students that I'm working with, they want to invest for their future. They understand that this is an important thing, but they have a lot of anxiety around investing. So, in your opinion, how should they get over that anxiety?
Okay, all right. The first thing to do is to understand the history of. Let's start out. Let's just start out with you can invest. You can put your money in a savings account at a bank.
Mhm.
Okay. But
Mhm.
the sad reality is that hasn't produced an after inflation and after tax return for people over time. The banks have reserve requirements, they don't pay a lot of interest, and they never have. Uh, and even when interest rates were very high in the early 80s, there were more competitive instruments to invest in, short-term instruments. So there's no risk, so to speak, of losing your money because it's insured up to a certain amount of money and under the FDIC, Federal Deposit Insurance Corporation. But you're not going to really make any money. All right. So the biggest risk anybody could take is not taking risk.
Mm.
So if I could leave your audience with one message, is the biggest risk is not to take risk. Now, how do you take risk? You have to manage that risk, and you manage it relative to the opportunity that you wish to access. Okay, now what does that mean? Well, you can invest in real estate. It's usually, and you can do it through publicly traded stocks and real estate investment trusts. And there are various types of those. And I don't want to get in too much in the weeds on that, or you can invest in commodities. The problem with commodities historically is that when the price of a commodity goes up, the supply of that commodity also goes up, and ultimately the price will decline. And that happens with every commodity. And since you did, I think you mentioned Bitcoin or crypto. I don't know much about the other cryptos, but I know a lot about Bitcoin and have been involved with it for 7 years now, or more. The one thing about that, unlike commodities, is that it has a finite supply. Unlike gold, people talk about, oh, gold's a 5,000 year, store of value. But the problem with that is when the price of gold goes up, the incentive to mine it also goes up, and there's more supply. So the price will come down. And you can't really go into any place and give them a gold bar. Okay. You can't send it across the country or across the world. Well, you can on Bitcoin. Now, I'm not promoting Bitcoin as a speculative asset, but it's an asymmetrical asset. So the upside potential is much greater, even at $63,000 a Bitcoin these days, much greater than the downside risk in my humble opinion. So that a small position in that has been a prudent thing for investors to do over the last decade. That I'm not giving investment advice on that, but that's just my opinion. So where are we now? Well, stocks are the best way to maintain your purchasing power after tax and after inflation, and that the easiest way to do that is you can now invest in most of the larger firms have no minimums, okay, and almost no fees. When I say almost no, I mean there are a couple of hundredths of a percent. So that's really not much. Now, what's the significance of that? Well, over the last 100 years, the S&P 500, which is a benchmark that the institutions use, and it's a well-known index, has generated approximately 10% a year in dividends and price appreciation. Okay, and it's important to remember that. And that's happened. And during the Depression, the Great Depression, during 3 years of the Great Depression, the stock market was down 85%. So people lost literally almost all their money in the stock market. And then of course the dot-com crash was a 50% decline over a couple of years, actually more than 2 years. And then we had the great financial crisis in 2000 that began in October of 2007, with the market peaking in October of 2007, and it bottomed on March 9th of 2009. And then the COVID scare in February of 2020, only 4 years ago, the market went down 35% in 30 days. And it came right back. Now, in every instance, if people stayed invested, they made that 10% a year. Okay. If they got emotionally disturbed, upset, anxious, and they sold after it went down, they obviously did not participate in the recovery. And participating in a recovery after you sell stocks after a big loss is really hard to do. Okay. And the reason I wrote the book, one of the reasons I wrote the book, is I lived through 50 years of stock market activity. And it turns out that I started in the business in 1971, which coincidentally was when the US government suspended the convertibility of the dollar into gold. Because up till that point, foreign central banks could come and claim, get paid in gold for their dollar deposits. Okay. The problem is that the US didn't have enough gold to satisfy those demands, so President Nixon at the time suspended the convertibility. Well, since that time, the value of the dollar has gone down over 90% in that 52 or so years, 53 years now. Why is that? Well, we can go into the reasons for that, but the bottom line is that at the same time, the stock market's done about 10% a year in that 53 years. So wait a minute, what's going on with that? With the dollar went down 90% in value and stocks went up 10% a year. Not bad, not bad. Now people understand. Now we're going to talk about compound interest.
Yeah.
if you'd make 10% a year, and there's no guarantee that the market will do that again over the next 10, 15, 20, 100 years. There's no guarantee, but it has done that. And we can talk about why that has happened. But, and I'll talk about it right now. The reason it's happened is because corporations are incented to provide a return to shareholders. So corporate managements will adjust to conditions that exist at the moment to generate a return for their shareholders. And if they don't, guess what happens to them? They're gone.
Right.
Now, the other thing that you have to keep in mind is that the failure rate of companies is relatively high. So not every company that comes public and even gets listed on the New York Stock Exchange is around 10, 20, 30 years later. And we've seen how quickly things have changed. In the last 20 years, there were companies like General Electric 20, 25 years ago that was thought to be the master of the universe of corporations. And then it became, a pariah. I mean, it was just, and they had to break it up. And it was, and well, we can get into reasons for that, but management did not adjust. And so companies have to be able to adjust their strategies to the conditions of the moment or in the near future, and reinvent themselves.
Yeah.
And and when the other thing that's happened in the last 20 or so, 25 years, is we obviously know about Amazon and streaming video and more efficient ways to do things. And that's going to probably continue, and it's probably going to continue at a greater rate than we've seen in the last 20 or 10 or 20 years.
Mm-hmm.
So it's important to stay on top of that. And so companies will adjust to the conditions, and we see it all the time. I mean, so investing in an index captures all of the good decisions and all of the horrible decisions. But keep in mind that the Standard & Poor's 500 Stock Selection Committee only selects stocks to go into that index for companies that meet certain criteria of quality, okay, of earnings quality, of financial strength, and there are other criteria as well. But and there's no guarantee that they get it right either, because there are companies that have been in the S&P 500 that have not done well, and they've been kicked out of the S&P 500. But the point is that companies will win, companies will lose, but overall, you're getting the decisions of every investor, okay, who invests in those stocks in the S&P 500. You're getting all those decisions, and you're doing so for almost no fee. I mean, you can do it for like 0.03% through most of the big firms. And we can talk about different indices to invest in, but the one for the purpose of this conversation, the S&P 500 I think is sufficiently instructive, okay, for people to take. Now, okay, so your question is how do you overcome anxiety?
Mm-hmm.
By understanding history. Now, what is history? History is just as I've quickly recounted, and I talk fast, so I apologize if it's too fast, but the market will decline, and it may stay down for a long time. Okay, I mean, we just in between the March of 2000 and March of 2009, we had 250+% declines in the stock market, and the March 2000 lasted till October of 2002. Okay, so a couple of years, and the one obviously in 2000, the Great Financial Crisis, was another year and a half or so. But it was scary, and there's no guarantee. And the other thing that happens in these markets is, and I well remember this in early 2009, where it looked like the financial system almost collapsed. It literally almost collapsed. And we had Warren Buffett coming in to save Goldman Sachs, and I mean, there were all kinds of dramatic events that happened, but we survived. And we can talk about what is the Federal Reserve Bank's role in all of this, but that's getting a little into the weeds. But I'll be happy to do that if you have questions or if your audience does. But it's really important to remember the historical pattern, and that you have to kind of take it on. I hate to say this word, but you have to have confidence. I won't say faith. You have to have confidence that history will repeat itself. And what does that mean? What is the market? The market is a reflection of people's views of the future prospects of the economy and of companies in which they invest. Okay. And human behavior will probably not change a great deal over time. Okay. The market is subject to all kinds of panics and also, I mean, look, there's really no Armageddon or Nirvana, okay? And that the problem is that the popular press, the financial press, throws a lot of information at people every day about, particular stocks, Nvidia or this stock or that stock or Amazon or Tesla or you name it. All right. But if you're focusing on, it's almost like you're driving looking 2 inches in front of you. You have to drive so you're looking further out ahead of the car. And guess what? When you drive, the car's going to go where you're looking.
Mm-hmm.
If you're looking at a tree, you're going to run into a tree. All right. But if you're looking further out ahead down the road, you're going to be okay.
Mm-hmm.
And you're going to be able to anticipate, oh, I have to stop here. There's a big, puddle here. There's an accident here, et cetera. And, but when you're investing in stocks, you just have to understand that behavior probably will repeat itself. And it may take a while, and it will test your endurance. And one of the things I say in the book that is I think it's memorable, is, everybody knows who Mike Tyson is, the heavyweight boxing. And he said, everybody's got a plan until they get punched in the mouth.
Right.
And if you decide to invest in stocks, you better have a plan that's an enduring strategy. So how do you do that? You have to decide up front how much risk. There are 4 things you have to know: how much risk you want, how much risk you have in your portfolio, and how much risk you need to achieve your objective, and also what is the impact of fees on investing. And it's conventional, and that's the title of the book, is Beat the Wealth Management Hustle. It's conventional for people to hire advisors, and advisors typically charge about 1%. All right, let's see. If I make 10% a year and I'm paying 1%, so I'm paying somebody 10% to take risk with my money. Wait a minute, what? I'm paying somebody to take risk with my money, and they're going to take 10% of my return if I make money. If I lose money, they're still going to take fees. So unlike the advertisements that you see, we only make money when you make money. No. They make money even if you lose money. They just make lower fees.
Mm-hmm.
They still make fees. So it's important to recognize that. What is the value of compounding? It's quite amazing. And compound interest is like a snowball, and it's rolling down a hill and it's gathering steam. And so you're getting interest on interest over time. So the most important thing to get to that your audience should know is that time in the stock market is the most important thing. It's not timing in the stock market. Okay. And I don't have charts and graphs in my book for a good reason, because they will change, and I want something that's enduring in the book as an example. But just as an example, people say, well, but I can avoid the downturns and I can just capture the upswings. Well, I, as a professional investor, having interviewed some of the best hedge fund managers and investment managers in the world, literally, for my clients, and I had endowment clients and wealthy individuals as clients. I've only met 1 or 2 people who were any good at timing the stock market. All right, what are the numbers? Well, we did this study at the firm, and I closed the firm in 19. But anyway, this study goes from 1961 till to the end of 2017. If you invested in the S&P 500 $1 in 1961, you would have had $182.92 by the end of 2017.
Mm-hmm.
If you invested $1 in U.S. Treasury bills, you would have gotten $14.42.
Wow.
All right, $182 versus $14 or $15, call it.
Big difference. Mm-hmm.
Yeah, and that's the difference between a 10% return or a 9.9% return and a 5% return.
Mm-hmm.
But if you missed 4% of the best months in the stock market in that period of time from 1961 to 2017, you would have had a return of less than Treasury bills. It would have been $14.26 if you missed 4% of the best months.
Mm.
And so what's that saying? That's saying that like 96% of the months, the market is not doing anything. It's going up and down, but it's not making any progress. It's just in those 4% of the months where it really expand. And so you have to be there. So that the probability of successfully timing the stock market is so low. Any statistics professor would confirm this. Okay, it's going to happen. And I don't want to get into standard deviation, all that stuff. But although it's important to understand the rudiments of that, and that's what I talk about in the book. But so how does somebody do it? Well, first of all, you can do it for no minimum. So you can go to some of the big firms, say, oh, look, I want to put $20 a week or $20 a month or $50 a month into the stock market, and you can do that. And your fees are going to be de minimis. They're not going to be much at all. and just understand that you're going to look at that portfolio, and don't look at it every day because you're going to probably freak out. But the temptation, look, there's a familiar temptation of people to try to time the market, and you can't succumb to the temptation.
Right.
And and don't buy into, I say, don't buy into the idea that there's somebody out there like the talking heads on the financial networks.
Mm-hmm.
Market's going to do this or that next week, and I trust me because I know. Well, what's their performance record?
Right.
Is it consistent? Is it persistent? They never talk about that, but they're always. I mean, it's really. I say it's shameful that these networks have such commentators on, because it's misleading and confusing, and people are intimidated. Don't be intimidated. It's not rocket science. 10% a year over longer periods of time, and if you invest over 10-year intervals, or very few intervals during which you wouldn't have made reasonable money in the stock market, more than savings accounts. But you have to be willing to, again, everybody's got a plan until they get punched in the mouth. But you are going to get punched in the mouth with your $50 a month program.
Right.
It's going to happen. All right. It will happen, but you've got to keep going. The other thing you have to do is keep putting the $50 a month in, or whatever you can afford. And the other thing about time, let's talk about time preference. Most people live right up to their income. They spend everything, and all right. So that's saying that they really don't have any interest in the future if they do that. And it's very easy to just spend everything you have. And in these days with inflation where it is, of course it's but the point is that if you save, you are preserving your purchasing power, and you're enhancing your purchasing power in the future is what you're doing. Not just preserving it, you're enhancing it. But you have to make a decision between how much am I going to save and how much am I going to spend. So how much do I want to weigh the present against the future? And that's a really hard decision for anybody to make, especially younger folks.
Yep.
But the advantage that your audience has is they are just that. They have time.
They have time. Yep.
I'm an old dude. I don't have time. I don't have as much time. Although my father's almost 100, so I might have less time. But the point is, they have a huge advantage.
Yeah.
And they can sustain that. And the other thing is, if they have confidence in themselves, they're going to earn more money over time, and they'll be able to save more money and invest more money. And take it from an old hand here, that as hard as it is, you've got to make that time preference decision. I want to save X percent versus spend Y percent. You've got to do that.
Right.
And if you don't, you're going to be sitting there 10 years from now saying, I should have done that. Why didn't I do that? If I had just put, and it's so easy today. You can go, they know how to use they know how to do compound interest tables. Just go and say, okay, what if I put X dollars a month and I make, even 5 or 6%, forget about 10%.
Right.
What's it going to be worth in 10, 20 years? And it's a lot. Okay, here's a number. I'll give you other numbers, and this is in the book. And this is my argument about why people should understand how much it costs to hire an advisor and pay them 1%. Okay, so let's take a hypothetical $500,000 portfolio. Now, most people, young people, won't have a $500,000 for years. Okay,
Right.
But when they do, it's important because, and they can do the numbers however you want. Do 1/10 of that, 1/100th of that, whatever. But a $500,000 portfolio that earns 7% a year for 20 years. Versus one that makes 6% a year. So if you're paying your advisor 1% a year, so you make 7, but you're paying them 1, so you're only getting 6. That 1% a year compounds to $331,000 over 20 years.
Wow.
Most people would say, well, it's like $30,000 or $40,000. No. It's over $300,000 difference because of the compounding effect.
Right.
So, and they can, look, I mean, when I was a kid, I'd have to use a slide rule to do that stuff, right? Literally. And then there was the HP, then there were computers that are handhelds that did that. And now there's the internet. You could do it on ChatGPT for, in 2 seconds. But so they should just run through those numbers and figure it out. And you don't have to. So instead of having the extra Starbucks or the extra beer or whatever,
Sure.
just say, cut back on 1 a week and, put that extra $20-$50 into an investment. And the thing is, you could have it deducted from your checking account, and, you can check it. I mean, and But if you hire an advisor, just understand that there are questions you have to ask that advisor. Now, most people just starting out are not going to hire an advisor. What they should do is they should just sit down and do simple math about, okay, here's my budget, here's my rent, here's my, food, here's my transportation, here's my whatever, figure it out. And if you could possibly do it, save some money.
Yeah, makes a lot of sense.
Put it
One thing I
aside.
wanted to ask you about is just kind of, you mentioned it earlier, the diminishing purchasing power of the dollar. It seems like the dollar doesn't go very far in the grocery stores these days. So what's happening? Why is the diminished purchasing power of the dollar, why is that so significant right
Well,
now?
all right, let's back up 100 years, okay?
Yeah.
Over 100 years. The Federal Reserve System was founded in 1913, and they issued the dollar as we know it today.
Hmm.
Up prior to that time, different banks issued currency, believe it or not. Anyway, so the Federal Reserve started issuing the dollar. That dollar today buys less than a penny of goods. Now, why is that? Well, inflation of prices is the reason for that. And now since COVID in the last 4 years, we're down over 20% in the purchasing power. What's going to happen in the future? The Federal Reserve is probably going to continue to print more money. And if the past is prologue, it's going to be worth less in the future. That dollar will be worth less in purchasing power in the future. So you can't really do much about inflation on a current basis, except maybe change your buying patterns, or maybe you want to substitute one thing for another thing that doesn't cost as much. There's not much you can do about inflation on a current basis, but there's something you can do about inflation over a 5-10 year period. Now, in the last 10 years, it cost what you could buy for $1 10 years ago now costs $1.35. I mean, it's like it's horrible, but other countries it's been far worse.
Yeah, that's true.
Other countries' currencies have completely failed.
Hmm. Hmm.
Argentina, Lebanon, Venezuela, other countries have failed. And that's the argument but I don't think that politicians are going to change what they've been doing. Okay, they're probably going to continue to do deficit spending. We're paying as much in national interest now as we're collecting in federal income taxes almost.
Hmm.
So we're just keeping our nose above the water, barely, but we can't pay off the debt. Now, there are solutions to that, but they are going to involve some pain, frankly, financial pain. But so I don't know if I answered your question about the diminishing purchasing power of the dollar, but over the long haul, it's gone down pretty steadily, but it's gone down especially fast in the last 50 years.
Yeah.
52 years.
Mm.
And because the money supply they keep printing dollars. What
Yeah.
does that mean? Well, the Federal Reserve System can create currency out of thin air. They press a button and they say, okay, well, we have another $1 billion today that we can go out and buy treasury securities with from the banks. And they do. And that's how they put the money in the system.
Mm.
That's what they do. And they'll see that. One of the things that's a little disturbing to me about the educational system, even in high school, much less colleges, is nobody seems to focus on finance and financial planning. And I don't know why that is, but I will also tell you, Michael, that most people don't even want to talk about investing. And these are people that are adults that have investment accounts and they've had some experience investing. They don't want to talk about it. Oh no, I leave that up to my advisor. I'm intimidated by it. I don't understand it. I can't figure it out. Okay. The other thing, and the reason I wrote the book, and if anybody buys the book, they'll see this instantly, that I wrote the book because in late 2022, I was at a party of a charitable group, and I didn't know anybody there. And I said, well, I had just retired from the investment business. And, they said, what should I do with my portfolio? And I said, well, I'm no longer giving license to give advice, so I'm not going to give you advice, and I wouldn't do it on a casual basis anyway. But I said, do you have an advisor? Yeah, I do. Well, you probably should ask your advisor what you should do, because the stock market in 22 was down about 20%. The bond market was similarly down about 20, a little less than 20. But that's a big decline in a given year. Oh, by the way, so I said, and then I started asking friends of mine, I said, do you know what you're paying your advisor? I have no idea. And I said, well, maybe you should ask. And you should also ask a few other questions to go along with that. Like, I'm paying you X percent. How much are you making above what I could make on my own after your fee? And it's a simple question, and if they can't answer the question, then you probably should do it yourself. And
Right.
that's the conclusion I come to in the book. Now, how do we gauge the amount of risk that somebody can tolerate? And I always say you have to understand your tolerance for investment risk before you exceed it. Okay, so you got to know ahead of time, this is my limit. I can't, here's what I'm going to do. All right. It turns out that there's another book that I highly recommend. It's by a psychologist who won the Nobel Prize for this theory back about 25 years ago. He recently passed away, Daniel Kahneman, and the book is Thinking Fast, Thinking Slow. And it gets at exactly that point. It also developed the prospect theory. What's prospect theory? Prospect theory is one where you're asking people iterative questions. Okay, how would you feel what would you feel like if you could make 20% a year, but to make 20, you might lose 12? No, 12 is too, I don't want to lose 12%. Okay, how about if you made 15, but you'd lose like 9? Well, that sounds a little better, but I still don't want to lose 9%. Well, okay. Well, how about 10 and you'd lose like 6? And these numbers are making up, but I mean,
Right.
I literally, through my own firm, I mean, there's a no cost, no obligation risk assessment questionnaire people can run through and get these numbers, but it's based on prospect theory, which is a Nobel Prize winning theory. And to me, and I've been at this for a long time, the most important thing for people to understand when they invest is to know their tolerance for risk, and they know what they're going to do before the decline happens. Okay. And are they going to stay there, or are they going to sell out? Okay. I can't make it any plainer than that. And the other thing that turns out is people can say, well, our performance is better than XYZ firm or ABC firm. Okay, that's good. How consistent is it? How persistent is your outperformance? Well, sometimes we're down, sometimes we're up, but overall we beat it. Okay, that's good. And is that after your fee? Yeah, that's after fees. Okay, that's good. But the point is that you can make competitive returns by investing in an index fund. As I've said, the S&P 500 is the one of choice, really. You can invest in others. The broad market index, I mean, other firms like Vanguard has a broad market index. But the point is that it will generate a competitive return relative to managed accounts.
Right.
Okay. And the industry, I'll keep going on this tack, because Wall Street is a sales machine. Okay. Wall Street sells stocks. Okay. That's what they do. And they're advertised as a powerful advertising machine, and they have people almost addicted to their services. Okay. Where people feel like, oh, I can't do it myself. I'm intimidated. I can't do that. But the reality is you get a competitive return in an index fund, and if for no other reason, because you're not paying any fees to speak of. You're paying 300% or about that, maybe a little more, but not much more than that. And so, it's a straightforward proposition to me, and it's one that Warren Buffett's been talking about for 50 years, and the late Jack Bogle, who started Vanguard, talked about that for 50 years as well. And it turns out that the simplest approach has been one of the most effective approaches.
Yeah.
And that's goes against most people's nature. Wait a minute, if it's that simple, how can it be any good? Well, guess it actually has been good.
Yeah.
And you don't have to trust me. Go ask any of the big firms for the numbers. They'll give you the numbers. Or you can go on the internet and get the numbers yourself. I mean, it's all of it. The other cool thing is unlike 50 years ago, is that this stuff is all accessible to everybody in a second. All right. And you just have to ask. You don't ask, you don't get.
Yeah, this has been a really, really great overview, I think, for college students to listen to really get a better understanding of their investments. So I really, really appreciate it. And your book, of course, is called Beat the Wealth Management Hustle. So I encourage everybody to go out there and get the book, because it's really going to explain everything in great detail. It even has a foreword by financier and well-known media personality Anthony Scaramucci, of all people. So that's really kind of cool to to have that as your intro on the book. I like that a lot. And so this has all been really great. I think this is absolutely fantastic. So if our listeners, if they want to buy your book or they want to contact you for investment help, how can they best connect with you?
Well, okay. First of all, the book's on Amazon and other at other booksellers. And I haven't gotten too involved in the other booksellers, but I think it's Barnes and Noble and other places it's available. It's a paperback is and also on Kindle. I don't have an Audible version, but I may. Um, and and my email address is, I think it's on the back cover, but it's my email address is ADP, my initials, Alpha Delta Papa, at victoryroad.com. Now, what is Victory Road? Okay, where'd that come from? Well, my office address for 25 years was 500 Victory Road. And Victory Road was a road that went through the Bethlehem Steel shipbuilding plant that built destroyers in World War I for the Navy in Quincy, Massachusetts. So that's the Victory Road. So I started victoryroad.com as a domain back in June of 2000, actually. So I just kept victoryroad.com as my domain and my email address, and they can find out other stuff from that if they want. That's where it's at.
Very good. Victoryroad.com. Go and check out the book on Amazon. It's called Beat the Wealth Management Hustle. So we really appreciate this, Andrew. This has been some great information, some great background that I'm sure a lot of our listeners learned for the first time. So this has really been helpful. Thank you for sharing all this great info with us today.
It's my pleasure. It's my pleasure. If I could help one person, and they think about it 10 years from now, hey, that guy was really helpful to me, I'm happy.
That sounds like a deal. All right. Thank you, Andrew. And to our listeners, if you enjoyed this conversation with Andrew, I want you to like it on social media, share it with other college students that share that love of investing for the future. And we hope to see you on another episode of the Fraternity Foodie Podcast. Thanks for joining us. We'll see you next time.